That
But
goes
you
to
have,
the next chart that I wanted to show. And if we could just pull up the next chart. Yeah, this is exactly what you were talking about, John. The components of the CPI broken down: used cars, gasoline, used vehicles, airfare, transportation. These are the components that have grown the most in the CPI index, the basket of goods. I want to ask you for your projections now in this second part of our interview, your projections for inflation going forward. Do you agree with Fed Chair Jerome Powell that inflationary forces are only transitory, and that the items on this table here, for example, that have grown the most in price will eventually come back down in price once supply issues are fixed?
well, I think you're going to see. No, first of all, I don't see the inflation as being transitory. I think we've got a very large inflation problem in hand, and one that is going to accelerate in the months ahead. You're sure you're going to have things that shift around and with different shortages and such. And again, you have the cash out there going after the shortage in goods. You have a shortage in automobile manufacturing right now because there are chip shortages. But that's where you start to get some of the funny shift in inflation. Eventually, some of those things will work out. But if you look at the core inflation, the gasoline or the energy there was 3 or 4 down.
Yes.
Gasoline, that's up 45%. Well, right now, and that's a 12-month change. Keep in mind that last year you had an oil price war, and gasoline prices were
Right.
artificially depressed. So that's what you're seeing there. But guess what? If you look at the CPI or the PPI, the Producer Price Index, and look at the core inflation net of food and energy, you still have record levels. It's not. Yes, the gasoline's up sharply, and the rental cars, again, there may be some balancing that works out there, but what you look at down the line, basically overall inflation right now, which is your yellow line, that is technically a 13-year high, but it's within 0.2% of being a 41-year high, and that's artificially depressed because of all the changes that they've made to the CPI.
All right.
What I'm looking at right now is also, it's already reached that 41, 42-year high, but it's up over the 13%.
Okay. John, I wanted to ask you for your outlook on inflation. You said that it's going to get higher. Do you think, and you used the word hyperinflation several times throughout this interview, in the first and second part, do you think we could potentially see hyperinflationary scenarios like the Weimar Republic? You mentioned the Weimar Republic. Do you think that could be the future of the United States?
Yes, it could be. What you're seeing right now in the way of what the Fed's doing, and it's money creation. It's still growing, expanding year over year. And again, the most liquid measure, what I call the basic M1, is up over 80% from its pre-pandemic level. You've never seen anything. As it increases here, the Fed's not about to pull back. They can't. The system's not stable. It's a very difficult and dangerous circumstance. But I think you're going to see that continue to spike. If the Fed can find a way of bringing down their money supply growth sharply, there may be a chance of containing it. But if we keep going like we're going, I'll contend that a lot of the inflation that you're seeing here is beginning to reflect that extraordinary money supply growth, and it's going to accelerate over the next 6 months. You figure there's at least a 3-4 month lead time with things, and so a lot of that's already in place. You're not going to see any pullback, at least for a couple of months. But if the Fed can somehow bring its money growth back under control and get back to pre-pandemic levels. One can hope they'll do that, but you have to get outside of the current circumstance before they can do that. They have to get the system stable. The system is not stable. The economy is not stable.
Yeah, well, John, some might argue that the situation of hyperinflation in the Weimar Republic, that's unfathomable for the United States. We have the strongest economy in the world. We have the most stable form of government, one might argue, in the world. We have a dollar that is the reserve currency, de facto reserve currency of the world. The notion of going to a restaurant, for example, and then having your menu bill doubled in 20 minutes time, that's a situation that has never before been seen in the United States. But you're arguing that it could happen. How can we get there from where we are currently to that scenario, which is what the Germans experienced in the 20s?
Well, again, we're seeing inflation now that effectively hasn't been seen in 40 years. And keep in mind that they're happily understating it, but government's number was at 5.4%. My estimate was up around 13.5% or such. That differential, the differential there is going to disappear because the differential isn't that great. You're going to see the hyperinflation in the headline CPI as it picks up. Just watch the pace. You start getting up over 10%, which you could see easily by the end of the year. I'm talking now in terms of year-over-year change, or against pre-pandemic peak levels, and that's all of a sudden you're moving beyond the things that have been seen here before, and it'll tend to accelerate.
All right.
It depends on how the Fed handles its money supply circumstance, but they're not doing anything at the moment to quell it. I know they'd liked it. They've had a little bit of rumblings about maybe changing things in a year or two, but right now they're still accelerating the process.
What's that going to mean for the standard of living of Americans going forward in the next few decades if what you're describing, the pace of inflation, continues to accelerate? What does that mean for the young person like me who has loads of college debt, some of whom can't even afford a house right now, which is not the case for many people in the 60s, 70s, perhaps even early 80s. Younger people back then had an easier time buying their first home in their younger years. We're seeing home ownership rates fall and debts skyrocket. And yet you're saying inflation is going to continue to rise. What's that going to mean for the standard of living?
Well, there are two angles from that. One, in terms of debt, inflation is the debtor's friend. Unless what you owe is somehow indexed to inflation. Hyperinflation, your debts become worthless. If the United States had a hyperinflation of the magnitude of what happened in Zimbabwe, it could pay off its entire federal debt, all its obligations, cover whatever it has to cover for less than a penny. That's an extreme. So if you have a hyperinflation, the debts become very cheap in terms of the current dollars.
So we should load up on our credit cards right now. That's what you're saying.
Yeah, well, there's another angle to this, which is a positive one, and that is to hold physical precious metals, gold and silver. Over time, they have held the value, real purchasing power of the whatever currencies around, or in some events, the gold or silver has been the currency. You can go back to ancient Rome, and for the same amount of precious metal in those days to buy a loaf of bread, you could buy a loaf of bread today. There was addressing a monetary conference a couple of years ago, and one guy raised a point that his mother, when she was a little girl, enjoyed going to Broadway shows, and the family would always get her seat to third row center, which is, I guess, considered the prime seat. It cost $5. He says, "Well, it's just out of control today." And I said, "Well, if she still had that $5 gold pieces, she could still buy herself a seat on third row center." It preserves the purchasing power time. And one thing I found, and this was accidental, when I created my index, adjusting for all the changes going forward, I went back and found a common point in time. I think it was 1970. Nothing had happened then, so I set my index equal to whatever the index was at the time, and it wasn't that far from the price of gold. I say I'm talking the CPI index, and so what I did going forward. I mean, the first decade or so, things move together, and then you start putting in the changes as they come along.
Yeah.
And at the last iteration, I plotted my index along with the price of gold over time just to see what it looked like, and it tracked. I mean, right up, but the price of gold led the inflation a little bit. And what I can tell you is that if you see gold soaring, that's probably the best indication, unless there's a lot of heavy intervention by the government or such. It's the best indication that you've got the inflation's about to pick up. The gold.
I've done a similar study myself. I plotted the gold price next to the CPI index, not yours, the government measures. And over the I started it back from 1980, and there were periods of time when gold has lagged CPI, but over the last 40 years, it's tracked CPI quite consistently. In fact, it's ended up at the same point. If you base both series back to 100, it's ended up at the same point now, at about 3.5 times its starting point. So you're right, it does track inflation quite well over the long term. I mean, barring seasonal and short-term volatility and spikes here and there. John, I wanted to ask you if you've done the same study for any other assets, real estate, stock indices, for example. Are they also good in inflation hedges?
Well, traditionally they are. The real estate, I mean, the term real, you use the real economic measure. It's adjusted for inflation. The real means it's a solid asset. It'll generally move. It'll cover inflation. Problem is, it's not exactly portable. But if you're holding the real estate, you'll tend to maintain the value of your real estate in a time of bad inflation. That's one reason that housing prices are soaring right now. What was the other?
Stocks. The S&P 500 over the last 50 years have performed quite well as well. Yes. Stocks
do tend to be something of an inflation hedge there too. But the circumstances here, I think, are going to turn very negative in terms of financial conditions, profits. It's going to be at a very unstable time. I would much prefer to have my assets sitting in physical gold and silver.
Well, one interesting thing has been happening, John, is the quit rate. The number of people quitting in the workforce has been skyrocketing. Now, a lot of economists might see this as a sign of confidence. People quit because they are confident they're likely to get a better job. Do you count that as part of the unemployment rate as well, when people quit their job and they're transitioning between jobs? Is that part of your calculation?
Well, my calculation is basically built upon the government. And if a person quits a job, so let's say they're unemployed, but they're actively looking for work, they're counted as unemployed.
Okay.
If they're not actively looking for work, then they're a discouraged worker, and they'd move into the U6 category.
I see. Okay. Well, it might be a good thing that they're actively looking for work. Suppose the economy does open up down the line and things recover back to normal. It's there's a shortage of labor right now. Employers can't fill up their positions. the quit rate, the skyrocketing quit rate might actually be a good thing, right? It should, in theory, bring down the unemployment rate going forward.
Well, let me put it this way. We're far from full employment, for stable unemployment. The numbers are
Yes.
not particularly good, and it's really quite frightening. If you look at the payroll employment of all the series that the government has out there, and I've had issue with payroll numbers over time, it is still probably the best quality series out there. It's consistently surveyed. The survey is of people who actually are employing people, paying payroll taxes, so that there's a hard paper trail behind that. And what you're seeing now, this is just going back from the pre-pandemic peak period,
yes,
to where you are today. And right now, you're about, I think it's 4% below the pre-pandemic peak. Now, people say, oh, the economy's recovering. Look at the GDP numbers, and again, I've got a lot of problems there. The GDP's getting close to being recovered. Payroll is as basic an economic number as you have. And if you're down 4% from the pre-pandemic peak, well, you go back and look at that historically. You did hit that in the Great Recession. And prior to that, you're looking back to the reorganization of the economy after World War II. This is not a healthy economy. And when I say it's 4% below, that's the actual number of people employed versus where you were at the pre-pandemic peak. What's not taken into account here is that in the period of time here that has passed since the pandemic hit, you normally have had 1.5, 2 million people join the labor force. So that is not there. Those payroll jobs just have never been created. So if you want to get the economy back to where it was, and payroll is back to a level that would be consistent with where it was before the pandemic, you had this last month a big surge of 830,000 jobs that's on the payrolls. If you had that for every month going forward here, it'd be early 2023 before you got back to where you were pre-pandemic. And I don't think you're going to see that happening, because there's all sorts of signs that the economy is beginning to soften again. The pandemic is something I have no idea how it's going to go, but there's some indications that there may be some new troubles developing. Talk about new shutdowns and such. Hope not, because that does really hurt the hurt economic activity. But as long as you're in that circumstance, the Fed's going to continue to print the money, and the federal government's going to continue to provide stimulus spending, and that becomes very inflationary. And that's why we're beginning to see the pickup in inflation. I know if you look at the velocity of money, the speed with which the money supply turns over in the GDP, people often look at that and say, "Oh, you have to have a high the velocity of money in order to have a strong inflation." Well, in some cases that's true. If you have the money supplies turning over rapidly in the economy, that will tend to give you some inflation. Also tend to give you a strong economy. That's a good sign. To the extent you have a happy inflation being driven by strong economic growth would be the preference. We don't have that circumstance right now. What we have is very low velocity, because you have extreme money supply growth and a very depressed economy. So it's turning over at an extraordinarily slow pace. And that's the type of circumstance that gives you hyperinflation. You look at the Weimar Republic, Venezuela, Zimbabwe. Those are not circumstances of strong activity economies that were, the strong economies are driving inflation. That's a circumstance where you had just too much money chasing too few goods. And that's a circumstance that we have now. And the inflation, yes, I know the used cars are up a lot, but a lot is happening here. You talk to people in industry. I have a number of clients who are in the supply area where they're intermediaries, and in some places, I was in the chemical industry, they're looking at 50 to 80% year-over-year changes in the raw materials. That's how they're passing the prices along, and they're not having any problem passing the prices along. I'm being told that's people are accepting it, and it's working its way into the system. You have a major inflation problem coming, and the broad CPI, not just used cars.
Absolutely. Well, I think many people watching the show might agree with you. And before we let you go, John, tell us about yourself, your background. Give us a bit about your background, what it is you've done before compiling statistics for ShadowStats, and where people can learn more about your work.
Well, they want to learn more about my work. They just go to my website, which is ShadowStats.com. Or you just drop me an email, John Williams at ShadowStats.com. Any questions, I'm happy to address them. I went to Dartmouth College, Tuck Business School, majored in economics and business, got into econometric modeling. After family business, which was importing chainsaws from West Germany, sold the manufacturing back to the manufacturing, and I started my own economic forecasting company, developed some new approaches to econometric modeling with a mathematical genius that I came across, and we did some interesting things with that, and we're actually able to forecast things, 6 to 9 months into the future based upon numbers that had already been reported. The problem with the big scale models of the economy, and they use them to predict what things are going to be 5 years from now, or even a year from now, is that in order to come out with a meaningful measure, you have to put in meaningful numbers, and if you have to put in a number for next year as to what inflation is going to be to predict interest rates. If you know where interest rates are going to be, I mean, if you know where inflation is going to be, you know where interest rates are going to be.
Absolutely.
So the long-term models don't do much, but as soon as it did that, then the government, and I started selling this to corporate America. The government started fooling around with its numbers, which made it difficult to predict them in standard econometric models. And people are interested in what was really happening there, and it's evolved to what it is today. I cover the economy. I assess it, and I give you an honest reading on it. I have no particular biases. I'm not trying to sell anything on Wall Street. I just try to give you the best reading I can as to where things stand and where things are likely to head.
Well, many people online watching this show right now do appreciate your work. As I said before to you offline as well, that your work is well cited by many economists I've already spoken to. So I do appreciate you coming on the show today. It's quite an honor speaking with you directly, John, and I do hope to speak with you again soon. Thank you for coming on Kitco today.
Thank you so much for having me, and great pleasure.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more information and follow me on Twitter at DavidLin_TV.